Hi everyone, it's Terrence here again, and today I want to talk about a really tough topic, cash flow management for a business. If there's any one thing that has kept me awake every night for 14 years, this would be it. It's easily the biggest source of stress that I've ever had, and something I wish I was good at earlier in my business career. And it can be so frustrating as a business owner that even though you're profitable and you're making money and it looks like you've nailed the biggest accounts of your life, there's just no cash in the bank and you're really struggling. Having cash in the bank is about the only way that you can solve your lack of sleep. So if you've never run a business before or you're not good at cash flow management, please do not skip this video. I'm going to talk about things that you can do to make your cash flow a little bit easier to manage. And at the end of this video, I'm going to walk you through a little spreadsheet that I've put together for you that you can use to measure how much cash you need and to safely guide yourself over the next 12 months. I'll put a link in the description, so if you just want to skip right to the cash flow calculator, feel free to do so. Now, why is managing cash flow so important? It is the way to kill your business. The day that you run out of cash and you can't pay your expenses, that's the day the door's shut. It doesn't matter how much you've invoiced. So it doesn't matter if you've invoiced a client for $2 billion tomorrow, but if you don't collect on that and you need to pay everyone right now, that could shut you down. So let's start by talking about running out of cash. Running out of cash equals going broke, equals shut down your business. Well, the first thing I'd like you to start thinking about is I'd like you to categorize all the cash outgoings that you've got in 5 categories. 5. And the 5 categories I'm going to give you are going to be in order of importance. So I'm going to start with the one that you've got to pay first, and then the ones that you can delay all the way to the end. The first category is your staff. If you don't pay your staff on time, they'll walk out the door and you'll lose them. They're the people that are working hardest for you, or they should be. So you need to look after them first. The best way to describe this is your staff aren't going to be tolerant. If they're expecting pay and they don't receive it, they're not going to be very tolerant. They're going to walk, and that's really going to hurt you. The second category that needs attention is your rent. So if you've got any rent or any financial obligations you need to make, so I'm going to count in with your rent, is your rent and any loans that you need to repay. They're the next on the stack that you need to pay. And the reason why they're second in the stack is that if you were to default on rent or default on a finance repayment, the worst that's going to happen, in a short period, call it 5-8 days, you might get stung with a little bit of a penalty, but it doesn't shut you down. You can survive a week, 2 weeks, and depending on your relationship and any conversations that you can have with your suppliers and your financiers, you might even be able to delay that a little bit more. So you have a little bit more breathing room in your rent and your financial obligations than you will with your staff. So they come second. The third one, which you can, depending on your situation, depending on how critical this is your suppliers. And you'll need to make a decision because the suppliers could be more important than your rent and your financial obligations. They might offer you 30-day terms. They might offer you 60-day terms. If you're able to negotiate longer terms, then they can support you grow your business. That's not necessarily something a supplier would prefer to do because they too are running a business, and you need to understand that when you don't pay your suppliers, you're putting their business under duress. But if push comes to shove and you've got a good relationship with your supplier and you don't abuse this, they can be a little bit tolerant and understanding, and you can buy yourself a little bit of cash flow time by delaying payments to a supplier. The fourth one on the stack would be your governments, your taxes, and the penalties. Now, I know that there are a lot of penalties involved with taxes. There's interest rates and then late payment fees and so on and so forth. But in all fairness, governments don't really want to shut you down. And again, if you're not abusing the system, the government will give you some time to make a repayment. On the worst case scenario, you can always make repayment plans with them and dig yourself out of a hole there. And of course, the last person to get paid on that stack will be you as the entrepreneur. It is your business after all. So if you find yourself in a really tough cash flow situation, your salary is probably the first thing that you can easily reach to. It's hard to expect the government, your suppliers, your staff, your landlord to be forgiving of you and to give you some space if you're not taking any personal sacrifices. So in a pinch, your salary goes first. Hey, it's ugly, but that's running a business. Which is why it's so important to manage your cash flow properly. Because ideally, you don't want to have anyone, including yourself, suffer from lack of cash flow. It's an ugly feeling. And early in my entrepreneurial career, I've had the doors shut on me. Quite literally, the landlord put a sign that said, "Do not enter. You have been evicted." Evicted! Oh man, is it an embarrassing feeling. So let's talk about a few things you can do to manage your cash flow better. This bit is boring as hell, but it matters. And you have to do it whether you like it or not. Work out if you're ever going to run out of cash and you solve that cash problem. There's no business strategy here. It's quite simply counting how much money comes in and how much money is going to go out. You should probably be looking at your cash flow situation at least once a month. And if you know what the numbers are supposed to look like, then all you're doing really is checking if the numbers are still correct and that you are on target. And that's really the only two things that you're looking at. Now, looking at the cash going out scenario first, obviously if cash is tight, you just need to find savings and you're going to have to be fairly ruthless to keep the costs down. And I use the word ruthless because it can feel very ruthless, especially when you have to let a staff member go. But you need to think about all the other people, all the other staff members and your suppliers and their jobs. All these other organizations and people are depending on the income that you drive as well. It's better to lose a person or the really sexy office that you've got to make sure that 5 or 6 other people are employed, not just in your business, but your suppliers' businesses as well. And to deal with the other side of the equation, which is the cash coming in scenario, really there's only a handful of things you can do. If you don't already work on a cash basis and you get all your money up front, which is ideal, you work in a space where you send a lot of invoices out to your clients. Ideally, you want to get your invoices out as quickly as you can. A big KPI that you can start establishing is the time it takes from raising an invoice and sending the invoice to your client to the day you get paid. Obviously, on a cash basis, that's 0 because you raise the invoice and they pay you instantly. But if you're offering 30-day terms, 60-day terms, 45-day terms, 14-day terms, you need to start measuring how long it takes before your clients pay you. If your business is big enough, another thing you can do is to hire someone to make sure those invoices go out on time and to chase up your clients before the due dates to remind them to make payments, particularly the difficult clients. If you can, automate some of this. Your invoices can go out automatically and you can get reports that automatically point out which clients haven't paid so you can contact them yourselves. Just be mindful of your automation. It isn't very nice to call up a client, particularly one that's been good to you over the years, and be rude with them and say, "Pay my bill now, pay my bill now." My approach has always been gently, gently, softly, softly. There's a good chance your client just forgot to make the payment, but sometimes they could also, just like you, be undergoing some difficult scenarios. If you're able to negotiate a part payment up front, hey, that's a great solution too. Take 20 to 30% of your payments up front, and that makes your life just a little bit easier. If you have a mix of payment terms in the way your business works, that's ideal. With your smaller transactions, try to get as much of that up front. And with your bigger transactions, they generally try to negotiate longer payment terms, so you might be stuck with longer payment terms. But with the smaller ones, try to get them early. Now, here's an interesting one. And I'm not necessarily a huge fan of the idea, but it does sort of work. And the idea is to basically offer an early payment discount. So if you pay a little bit earlier, I'll give you 2% discount on your bill or a 1% discount on your bill. Now, why I like it is that it encourages your clients to pay earlier, in theory. But it's almost always the clients that are fairly diligent already that will be enticed by this. The clients that aren't diligent, they usually will let it slide. So it doesn't really move the problem clients. It just gives a discount essentially to the clients that are probably quite good at paying. So essentially what's happening is you're losing 1% margin on your good clients. And it's also quite a hard program to put in place, because the moment you put a early payment discount in, your clients start expecting to have that. So once you've established an early payment discount, it gets hard to retract it. But the biggest bugbear I have with it is that even at 1%, and it doesn't sound like a lot, it's a huge discount. Think about it this way. If the net profit of your company sits somewhere between 5 and 10%, a 1% discount could be anywhere between a 10% to a 20% hit on your bottom line, which is huge. So of course you can inflate your pricing in general by 1% or 2%, and then you take it off on the other side. But then again, we're circled back to the beginning where you're only sort of giving a discount to your good clients, but the bad clients, well, they continue to be bad. Well, they're not bad as per se, they just don't like to pay bills on time. And you need to understand that there are some CFOs out there whose modus operandi is to make sure that they pay their suppliers as late as possible. So it can work, but not a big fan. Where I think it really works, which sort of ties into the next bit, is if you're using debtor finance. Now, if you're using debtor finance, in other words, there's a financier that's lending you money against an invoice that you've already sent. So you send the invoice and the financier lends you, a big portion of that invoice. Now, if you're already using that facility, then perhaps the discount works because it's a discount or a debtor finance. So if you're already using debtor finance, then the discount's an excellent thing to start putting in. But on the topic of debtor finance is expensive. And I'm going to make a whole other video just around debtor finance. I'm not a huge fan of that either. And there's so many reasons. You're killing your margin and you're taking some risks that really don't make sense. Another thing you can do is to include a broader range of payment methods. Things like accepting credit cards can be beneficial for you, particularly if you're servicing smaller businesses. Business owners there do like to swipe their credit cards because they enjoy grabbing the points. And if you bake in a couple of percent into your pricing by default, then you can afford to sort of give it away at the end in terms of taking either credit card charge or an early payment discount. For certain clients, that's actually really good because as a consequence of working with your business, they're able to rack up points on their card. So win-win for everyone. Win-win-win-win. The secret to good cash flow management is basically just making sure that you've got enough cash in the bank. It's that simple. And when you do have enough cash in the bank to start with, you'll actually be able to sleep at night. Unless things go horribly wrong, and that's a whole other video. So quick recap. Make sure you have enough cash. Make sure you have an accurate breakdown of all your cash outgoings based on the 5 different types of expenses you have. Try to get your invoices out as fast as possible. Discounting is an option to speed up the rate that you get paid, but it's not the best option. And the 5th one is debtor finance and cash flow finance, which you can get from financial institutions or your bank. All right, now for the bit that you've all been hanging out for, let's take a look at my cash flow tool, which I've put together for you. All this sheet intends to do is to try to work out for you how much cash you need to have in your bank. And it just allows you to quickly glance at your bank balance and go, I'm going to be okay. So fundamentally, what this sheet is doing is it's going to calculate what your cash requirement is. And using this fake company here, I've just sort of worked out that this company should aim to have about 86 grand in the bank at any point in time. Now, how does this tool work? It's actually really simple. So you remember in the beginning when I said you needed to work out how long it takes for you to receive payment from the time that you raise the invoice? Well, what I've done is I've broken down this company's clients into 4 different categories. The first bucket here is looking at the top 50% of clients that are on 30-day terms. And this one here is looking at the top 50% of clients that are on 14-day terms. This one would be the bottom half of the clients that are on 30-day terms. And this here being the bottom 50% of clients that are on 14-day terms. And in this column here, I've loaded in what is the average amount of days that those different types of clients pay by. But I've also put in here how long the longest invoice can take. And then on the final column, I've loaded in what the chances are, the percentage of clients that default or don't make payments. So looking at this here in this very top example here, basically, even though we've set 30-day terms for this company, it looks like it takes about 48 days on average to receive a payment, and sometimes their clients take up to 90 days before their payments are actually received. But fortunately for this company, none of them default. So the top clients pay really, really, really well. The calculator then takes this information here and just projects out what the likelihood is of you receiving your payments within 30 days, 60 days, 90, 120, and 150 days. What you do next is you just load in how much revenue or how much you think you're going to be invoicing for the 4 types of clients for your next 12 months. You don't have to do 12 months worth, you can just do 6 months worth, but by getting a good view for as far as you can see helps you out. And then you can put in how much you planned for your expenses. I've just broken it down into the 5 categories here. And if you've been fortunate enough to organize your chart of accounts, then this should be quite easy for you to produce and just quickly forecast how much you think your cash outgoings are going to be. Now note that this is cash outgoings. So this isn't on an accrual basis. This is on a cash basis. And if you're not familiar with what that means, have a chat with your accountant. But it just basically means the actual amount of cash that needs to go out. From there, the spreadsheet just simply calculates out how much it thinks you're going to be receiving from the invoices that you have raised. And then at the very bottom, what it's doing is it's giving you a summary. It's showing you that this is how much you think you're going to be invoicing, and this is how much it thinks you're going to receive. And when you look over it over 12 months, we've actually quite simply worked out that we think we're going to raise about $658,000 of invoices, but we're likely in the next 12 months to only really receive $571,000 of those invoices. Because if you just look at that gap between $658,000 and $571,000, that is kind of the capital that you really ideally should have in your bank. So the $86,000 here is the amount of money that you require to bridge the gap from the amount of cash you're going to receive versus the amount of cash you have invoiced. Because when you're looking at how your company is performing, chances are you're looking at the amount of invoices you're raising versus the expenses that you have. But that's not a cash view. A cash view is strictly looking at the cash in and out space with the purpose of making sure that you don't die. So in this table here, it helps me identify if I'm going to be running out of cash in any particular month. And my preferred way of working this is to put 0 on month 1. You'll notice that this spreadsheet doesn't factor in payments for invoices you have raised prior to the current month. It is a little bit pessimistic, but when we're looking at cash flow, pessimism is a good thing. So I prefer putting 0 in here, so I'm just going to pretend as if I started with no money. What would this look like? And if I had no money, by the 3rd month, I'm going to be in a spot where I'm going to be about $34,000 down. So assuming that everything goes to plan perfectly, $34,000 in the bank in the beginning should be fine. See, if I put that in now, I'll put in 35,000, right? That's 350, 35,000. You'll notice that my bank never really runs out. So I'm in a pretty good space for the next 12 months so long as I have $35,000. I like to think of this as the minimum amount of working capital I need to have, where the ideal is somewhere about 86,000. So if I don't have $35,000, I'm going to have to start getting very creative on where I'm going to get that. There's a really high chance that if you're playing with the minimum working capital level, that you're going to have to play all sorts of cash delay games to survive. If you're looking at this number here instead, having an $86,000 or $87,000 bank balances, you're pretty much set for the next 12 months. Chances are you won't ever really need to think about it much. You just need to monitor it a little bit. This is a fairly loose guide. You'll work out from using this sheet and monitoring this over time whether $35,000 is going to be fine or $86,000 is going to be fine. But think of this like you're playing a game of poker. If you're playing with $35,000, you're on a short stack and you don't have very deep pockets. So if anything goes wrong, you can be in a hell of a lot of trouble. Having 86 grand buys you quite a bit more time. Anyway, this spreadsheet's a good starting point. I'm going to put a link on it somewhere. Hopefully you guys can find it. If you can't find it, hit me up for it and I'll send it to you. Feel free to take it and hack it around and make it work for you. Of course, for this spreadsheet to work, it's going to require that you can quite accurately measure how long it takes for you to get settlement and put in realistic default rates. It requires you to be able to forecast your revenue quite well and plan your expenses well. So you will require a little bit of diligence on this, but it shouldn't take you more than an hour or two a month. Once you get the hang of it, this should be quite simple, and some of this could be done by your administration team anyway. Well done for making it this far. I can really use your help here. If you found this video useful, do let me know in the comments because I can make a lot more detailed videos like this. But of course, if you prefer higher level videos where I talk about things a lot more broadly, please let me know in the comments as well. That would be really handy for me because I fundamentally just want to make videos that can help you run businesses better. If there are any topics that you want to get me to do a deep dive in, hit me up, message me, type it into the comments. I'd love to help out. Alright, enough about cash flow management. I'll see you guys next time. Don't forget to smash that like button and hit the old subscribe button too. See you guys later. Bye.